Stimulus forced the Fed to move faster than it expects. I'm here with my co-host each and every Fed day, Tom Keene of Bloomberg Surveillance. We convince you to stay past your bedtime.
Well, it's just absolutely, and it's a real meeting this time. The last time was a snooze fest. We had a great conversation on where the Fed's going for 2018.
We always have a great conversation.
Well, we do. We always have a great conversation. But this time around, this is the real deal. There's a presumed rate increase, but much more than that.
Yeah, it's going to set the scene for 2018 when you have a whole new cast of characters.
And I'll be amazed to see how she handles this supposedly last press conference.
You think she's going to say something different?
She may break into tears. Mike McKee may ask her a vicious question.
Well, reporters might break into tears.
Well, we'll have to see. Let me do a data check right now and set this up for you here with some great guests coming up, including former governors Michigan and Krosner. There we are, up a large amount in the Dow, 24,600. When Neil Sauce and I walked into the market, I think we were at Dow 800 a few years ago. The VIX pretty much unched 9.89 with the yields in. That should be red on the screen, 2.37%. 3 basis points lower on the 10-year yield, 1 basis point on the 2-year, and that was the benign, relatively benign inflation today. Let's go over to that spread that's everybody looking at, the 8, 9, 10 spreads. This is the vanilla spread in nicely, curve flattening down to 55.52. The yen strengthens, dollar churning in a bit weaker on DXY. And I'd note gold up a little bit off the recent lows as well. But it's very good to have you with us on Bloomberg Radio. Good afternoon, I should say. I'm used
to
saying
good morning somewhere.
Yeah, it's good morning in Asia. Good morning in Asia. And, of course, to our digital audience worldwide, Radio London, good morning. And on television, we greet you worldwide with wonderful guests today. We've got Rick Mishkin, Randy Krosner, the former governor of Chicago. Diane Swank is with us as we speak. And the vice chairman of Credit Suisse, Neil Sauce, is with us as well. Dr. Sauce, what's the importance of this meeting, this final meeting for Janet Yellen?
Well, before we get to what's important for her, what's important for the markets and for our future is what do they expect economic performance to be? Has that changed since the last time they told us about their expectations? And in consequence, what does that imply for the evolution of interest rates and so forth? For Janet Yellen, it's a valedictory. And I think she has every right to be asked the question of what are you most proud of in your performance? And I think the right answer, both for her and for the country, is, well, I was there when unemployment came down from 10% to 4%. That's quite an achievement on behalf of the American people that she's charged with benefiting.
Let's see if she takes a victory lap. Diane Swank, what are you going to be looking at, listening for in today's meeting?
Well, I think the key issue is inflation and how they feel about inflation, because there is a growing minority within the Fed that are more concerned about the persistence of low inflation and it's not as transitory as they wanted it to be. And I think we'll only get one dissent that said there is this sort of growing feeling that perhaps inflation may not be coming back as rapid as they like. And so we may see some more outliers on the lower end, even though the economic performance on the dot plot, even though the economic performance has actually been much better than they expected.
Yeah, and it's telling in that the Fed under Janet Yellen has also said that it's quite a mystery why inflation hasn't gotten to where it should be. I mean, it's an acknowledgement that it's something beyond the reasons that they've given in the past.
Yeah, I would go with that. Diane Swank, let me talk about the legacy of Chair Yellen here among a number of the things. Well, we're going to go to the decision here in 33 seconds, so let's wait on the legacy of Chair Yellen. I really want to talk to you about fully employed America. I think that Dr. Swank has a great perspective from Chicago as well. Scarlett, as we look at the markets before Michael McKee, set it up for us.
Yeah, well, we have a flat yield curve, as you mentioned. We also have stocks, if you look at the S&P and the Dow, at record highs. They closed at record highs yesterday. They continue to move higher. The dollar, as you mentioned, losing some ground today, weaker versus the yen, euro, and pound. The 10-year yield is coming in a bit with bonds higher. Let's check in with Michael McKee now.
You'll not be surprised the benchmark rate goes up a quarter percentage point to a range of 1.25% to 1.5%. But there is a surprise in the Fed's growth forecast. GDP next year is seen expanding at a 2.5% pace, up from a 2.1% consensus forecast in September, probably due to tax cuts. The effect fades rapidly, though, with growth of just 2.1% in 2019, 2% in 2020, and long-range potential growth of just 1.8%. Unemployment falls below 4%, the Fed says, next year, 3.9%, the consensus for next year and 2019. And the inflation rate isn't changed by that. It stays at 1.9%. PCE index for 2018 hits the target of 2% in 2020. Stronger growth, lower unemployment don't change interest rates either. The dot plot stays about the same with a median forecast consensus of 3 rate moves next year and 2 in 2019, a long-range terminal rate of 2.8%. As for today's decision, well, the members cited an economy growing at a solid pace with solid job growth as you average through the hurricane-related fluctuations. As their forecast shows, they do expect inflation to pick up, although, as they said in September and in November, they are monitoring inflation developments closely. They did change their labor market outlook. Instead of expecting it to continue to strengthen somewhat further, that's the old language. The new language expects the labor market to remain strong, perhaps a little bit of a downgrade in terms of monthly job growth ahead. There were 2 dissents, Chicago's Evans and Minneapolis's Kashkari. The first time that we have seen dissents, 2 dissents in favor of a looser policy since 2002. The first time 2 bank presidents have dissented for looser policy since 1983. What to make of it all? Well, probably not too much, given that there is a possibility we'll have 4 new board members and 2 new bank presidents submitting forecasts next year. The dissenters, Evans and Kashkari, rotate out of the voting members of the committee. And after the January meeting, guys, Janet Yellen, the chair, is gone.
Well, Mike, greatly appreciate your complete summary. I am absolutely floored at your kindness over the Evans and Kashkari dissents. I guess we would expect that from the original president of the Minneapolis Fed. But Mr. Evans of Chicago has an immense respect. What's your why for why Mr. Evans would dissent from this decision? How rude to the outgoing chair.
Well, he's been seeing inflation rising very slowly for quite some time. It has a more dovish reputation, and he has said that he would like to see actual evidence that inflation is picking up before he votes for another rate increase. He won't have that opportunity for another 2 years.
Walk us through again the economic projections here, because as you mentioned, we see a bit of a pickup in GDP to 2.5% to 2.1%, probably due to taxes?
Probably due to taxes. We'll ask Janet Yellen about that, of course, when she has her news conference starting in about a half an hour. But that's one of the bigger moves from 2.1 to 2.5 that I have seen between meetings. And about the only thing you can think of is that they're seeing a fiscal stimulus in that. And then the important thing is they don't see much happening after that. The effect fades very rapidly down to 2.1%, then 2%. And long-range potential growth isn't affected at all right now, 1.8%.
Let's go to Diane Swank in Chicago. She's got a good handle on the president of Chicago. Diane, I find 2 dissents really extraordinary. Were you prepared for a dissent from Mr. Evans?
Well, I originally thought there'd be 2 dissents when I thought Janet Yellen would be continuing on. I'm a little surprised that he did it at this meeting, but I know Charlie well. And I also know that when you see someone make that kind of vote for a dissent, they're voting for more than one person in the room. And so he's also casting a vote for other people in the room that are concerned about the low persistence of low inflation, this sort of conundrum we're in of sort of too low inflation but an accelerating economy. I'd also note I have a 2.5% growth forecast for next year with almost no tax cut effects at all. There is a little more spending in the outlook, but we do have some self-feeding momentum now, and that's showing up in the economy. So you can get to that 2.5% without getting a big fiscal stimulus from tax cuts.
A little bit of economic history here. Dr. Sauce, let's go to freshwater economics versus saltwater economics, and that leads back to the foundation of the Phillips curve. Evans of Chicago, a tradition out of Chicago. Maybe it's the late Alan Meltzer at Carnegie Mellon and others, and Minneapolis maybe in its own unique orbit. But is there almost a Midwest protest here against the people on the East Coast, particularly wedded to Phillips curve dynamics?
Oh, I don't think it's as regional as all that. It strikes me that the puzzle is easily resolved if you accept the idea that the parameters of the Phillips curve can change from time to time and depend on demographic and other circumstances. That's a hard thing to absorb and to make policy on, because you don't know in real time that something like that has happened. And so the puzzle at the moment is, if it's happened, Is it a transient phenomenon? Do we restore the kind of shape to the Phillips curve that we experienced in the past? Or is this a more permanent and enduring change?
Neil, let me ask you, this might seem like an obvious question, but why do we care whether two Fed presidents dissented, particularly if they're going to be rotated out anyway next year?
I don't think, the only reason I could think of would be Diane's observation that this in some sense represents less firmly held but nonetheless sympathetic views by others in the room. I actually think in a way it's a mark of respect for the chair to continue with views that you've been expressing rather than saying, oh, it's your last meeting, therefore we're not going to dissent or otherwise continue to express those views.
Well, let's bring up DOTSCO right now. Take a look at it. There you see the 2-10 spread coming in a little bit with lower yields off of this meeting. Michael McKee, help us with the dots and the dynamics of the guesstimates of inflation forward. What is important going to January 31?
Well, what seems to be important is that they see the economy strengthening a lot next year, and they see the unemployment rate falling below 4%, but they don't see that having any effect on inflation. And there's a kind of conundrum there that I would be interested in hearing Janet Yellen explain. And if inflation's not going up, you wouldn't expect them to have to move the dot plot. But why does the Phillips curve not hold? Why shouldn't we see some faster inflation if we're going to get that kind of unemployment rate, and if we're going to see a 0.4 rise in GDP?
So if that's the case, Diane, to bring you into this conversation, if the growth is going to pick up quickly, unemployment will fall, but inflation won't move up. What does that mean for markets? How does it affect financial conditions?
Well, what it suggests is that they're seeing some productivity growth pick up and some more people slack actually come back. To have 2.5% growth and only have 3.9% on the unemployment rate and not like 3.5, that means a big change in the dynamic we've seen from the past, that they're going to re-engage some people, pull some people back into the labor force, which may not mean as much wage acceleration as we'd like and not as much inflation as we'd like. This is a conundrum that we're seeing being played out globally in Japan and in Germany as well, where labor markets are much tighter than they are here, and they still don't produce the wage acceleration and the inflation acceleration. And I think you're seeing that sort of acceptance of that, even though they don't quite understand why it's all happening.
Is that the model for us, Neil, that we're going to follow what happens in Europe and Japan?
Well, I think to the degree that you think there's a demographic force sitting beneath this change, if you go back to the 1970s, the Phillips curve was, so to speak, too steep. At any unemployment rate, you got more inflation than you expected. And I think that's because the labor markets were being flooded with new workers. Well, if you fast forward, those people have had a chance to learn the job, reach a different stage of life, and particularly a stage of career where the wage increases tend to peter out.
Michael McKee, a question for Dr. Suss.
Well, Neil, I want to ask you if, as Diane says, maybe they see productivity rising, and that's why we don't see an inflation change. How does it fall off so fast that we get growth accelerating in 2018, but then dropping back into the future and potential growth rate stays at 1.8%?
Yeah, I think some of what may be going on, in addition to the, what shall we say, substantive hypothesis that Diane advanced, is this may simply be a reflection of the arithmetic of the final 3 quarters of this year and the sort of jumping off point, the carryover, so to speak. And if that's the case, then you don't need deep substantive explanations. But I think what's interesting mainly is that the FOMC's projections for the long run parallel those of the bulk, I would say, of professional economists, to the effect that whatever this tax change is going to bring, it's not really going to raise potential GDP.
We're going to do a data check here in a minute. Good afternoon on Bloomberg Radio and Bloomberg Television Worldwide. We begin a substantial set of hours of Fed coverage. Governor of Michigan, Governor Krosner, will be with us later. Thrilled to bring them to you. I want to go to Dr. Swank right now in Chicago. Diane, you've written a terrific essay on the legacy of Chair Yellen. She will always be, for me, the slack chair. This word slack she owns, and she will forever own. Here's a chart, folks, of the miracle of unemployment. I'll let President Trump take credit. I'll let President Obama take credit. I'll let President Swank take credit. Let's give it to Chair Yellen, Diane. Is the slack still there? Is it dissipated, or is the labor slack gone, gone, gone?
Slack is still there. It's dissipated. It's not where Yellen was back in the 1990s during the economy, when literally there was a help wanted sign that the Fed Beige Book put out in March 2000, help wanted, pulse required. We're not there yet, but we're moving there, and we're better than we were. And what Chair Yellen really did was said the unemployment rate isn't the summary statistic itself. Look at the dashboard. Look at participation rates. And she helped remind us of the need to re-engage those who were hit hardest and left behind by the crisis, and actually those who we found have been structurally unemployed for quite some time now. And I think that's really an extraordinary legacy.
She was a breath of fresh air in that regard, because she talked about the labor market and thought about the labor market and consider the labor market in a way that we're not accustomed Fed chairs to doing.
As a human being, yeah, that's what we study human behavior, right?
How strange.
And she brought that humanity and grace to it with all of her intelligence and perspective and insights. And I think people really don't give her credit for how many different economies she's gone through. Remember, she started at the Fed during stagflation in the 1970s. Then she was in the 1990s at the Fed as well, and then through the 2000s, and then through the crisis, and on the other side of it. And she has never been ideological. She's been willing to shift as the ground shifted underneath her. I don't know anyone who's kept her balance and helped refocus us on what's most important about the economy. And that's ultimately how it affects individual lives.
I want to associate myself with those comments, and I wish I could have said it as well.
Neil Suss, when you look at this, there's a feeling of Jerome Powell, I get a sense, interview to interview, of immense competence. Mike McKee, frankly, is a lot better up to speed on this than I am. But we need a vice chair.
Yes.
Do we need a Janet Yellen-like vice chair to assist Chairman Powell?
Well, we need a vice chair. I'm not sure that we need a labor economist with all the experience that Janet Yellen brought to it. But we
Ed
clearly need someone.
Ed Lazier, Republican economist, could fit that mold out of Stanford, couldn't he?
I think that's probably right. And I think it probably would be useful to get someone who has a somewhat, what shall I say, theoretic rather than practical approach to backstop the chair. This is the first time in a very long time that you've had a practical person running the institution. That's probably a good thing by itself for a bit. But some kind of monetary policy has a deep theoretical interaction with the economy. It'd probably be useful to have someone there.
We'll welcome all of you on Bloomberg Radio Worldwide, Bloomberg Television as well. We need to tell you, Governor Krosner will be with us. The former Governor Frederick Mishkin of Columbia University will join us here in a bit. And Mike McKee, to go to Rick Mishkin, I will, of course, ask him about the ascendancy here of Marvin Goodfriend of Richmond and Carnegie Mellon. Mike McKee, do you just assume next year is a whole new look and feel for the Federal Reserve System?
Well, yes and no. It's going to be a whole new look and feel in terms of personnel, but will their forecast change all that much? I mean, Marvin Goodfriend, known for how he sees the process of making monetary policy different from others, but his analysis of the economy is pretty much straightforward, along with everyone else. So if we don't have any significant growth spurt from the tax package, or anything doesn't go particularly wrong next year, I don't think you'll see much different in the dot plot or in the economic forecasts.
If I can just add to that, it's interesting that the Chicago Fed has actually quoted Marvin Goodfriend on his inflation targeting over the last year, even though they're very dovish and Goodfriend's considered very hawkish in some ways. They really felt like they were in the same place, which is kind of an interesting thing given that Charlie just dissented.
You know, when we talk about this new look Fed in 2018, Chair Powell or Chairman Powell will be in charge. There's this theory, Neil, that new Fed chairs need to come in, or new central bank governors or central bankers need to come in and put their stamp on the central bank, really assert their independence, and they're going to raise rates as their first move. Granted, that's kind of the direction we're headed in anyway for this Federal Reserve. Do you believe in that theory?
I actually don't. I think the best way to build a reputation is to do the right thing. And you do the right thing depending on the circumstances. So I do expect that the Fed will raise interest rates in the early part of next year.
In March?
But whichever meeting. But the point is, it's not because Mr. Powell wants to assert that he's in charge. It's because the fundamental situation and the way the Fed analyzes that or as Mike McKee suggested, evolving in a fairly straightforward way right now.
We're going to suggest that Mike McKee exit stage right. Mr. McKee, of course, will be at the press conference. I'll make it very clear, folks, there's always a set of 4, 5, 6 questions that we really lean forward in this presser. We demand that one of those come from Mr. McKee today. He will grill the chair, we are sure, sharply as well. The remarks of Chair Yellen and the questions from the media, look for that at 2:30 p.m. Wall Street time, Eastern time as well. Let me do a data check. Equities, bonds, currencies, commodities, some movement here. Off a meeting, as Mike McKee said, maybe a tone here of not a dash to higher interest rates in there. Markets vault up 80, now up 111. The VIX was a 9.8 something into 9.77, and yields come in. I would like to see that red. 4 basis points on the 10-year, and the 2-year migrates over the last 24 hours from 1.84 down to a lower yield, 1.80. Next screen, please. And on the VIX, on 210 spread, some curve flattening, but not down to 53 basis points. Yen stronger, dollar weaker. And Scarlett, I'd also noticed gold 12.58 the ounce as well.
Yeah, about rebounding from a 5-month low there, gold futures. All right, this is The Fed Decides on Bloomberg Television and Bloomberg Radio. If you're just joining us, welcome. The Federal Reserve did raise interest rates by an expected 25 basis points. They also came out with new economic projections. Still with us is Neil Sass of Credit Suisse and Diane Swank of DS Economics. And joining us by phone is Professor Fred Mishkin, former Federal Reserve Governor, now a professor at Columbia Business School. Professor Mishkin, before we get to the new look of the Fed, I wanted to get your thoughts on the statement of economic projections and how the Federal Reserve is set up heading into 2018 under a new leadership.
So I think the issue for them is that we have two forces that are moving in opposite directions, and that's creating a little bit more complicated kind of discussion that they need to focus on. So the economy is growing very strongly. Not only is real GDP growing fast, but there's this potential for a tax bill that would be stimulatory. Also, financial conditions are actually quite easy, with a very strong stock market, for example, and long-term interest rates still remaining very low. So those are things that actually are pushing the Fed to raise rates. On the other hand, inflation has been very, very low. We have not seen inflation start moving up towards this 2% objective. Wage growth has also been very slow. So we're actually seeing a situation where the Fed keeps on thinking this is temporary, that in fact the inflation numbers are not very strong, particularly given how low unemployment is, but we just don't see it happening. And at some point, they may have to decide that it's not so temporary, that inflation is low, and that would change the way they do policy. So I think these are both moving in the opposite direction, and we can see that in the fact that we had some dissents at this meeting, basically because some people felt that inflation just isn't moving up towards where they need it to move up to. So in that sense,
right,
they have basically they're sitting with decisions which actually may change if inflation can't move up. This is actually something that's been a problem for quite a while.
We're with Rick Mishkin of Columbia University. Let's go to some breaking news. You see it there on Bloomberg Television. For those of you on radio, this from an historic vote in Parliament where the United Kingdom government loses a vote, and very simply your Parliament will have say on Brexit. You can hear the roar in Commons right now, the green leather of the House of Commons. After this historic vote, I know our John Farrow has been riveted by this through the day and through his many broadcasts. And we see sterling come in a little bit, a weaker sterling over the last 2 weeks. A real dynamic there of weaker sterling right now. That's right, Tanya. Show me that as you can. Now, this is sterling. You can see it just barely coming in over on the left side of the chart. Let us get back to our Fed coverage. Neil Sass with us with Credit Suisse, Diane Swank, and former Governor Mishkin with us right now. Rick Mishkin, let me bring up a quote. And I'm just having fun with this, Rick. Stay with me on this. 2004, 13 years ago, Rick Mishkin writing on Marvin Goodfriend. This is a long time ago and a crisis away. This is Mishkin. The Federal Reserve risks greater exposure than is necessary to, quote, inflation scares. The spontaneous increases in inflation fears described by Goodfriend 24 years ago that can become self-justifying if accommodated by the Federal Reserve. Rick, there is a greatest hits from 13 years ago on Marvin Goodfriend. From where you sit, Professor Mishkin, are we going to see a profoundly changed Fed if President Trump can select a set of governors, a chairman, and a new monetary vice chairman?
So I think we just don't know what Trump will do. But let's talk about what he has done. He's appointed Jay Powell, and Jay is not a movement away from what the Fed has been doing. And Marvin is, I think, an excellent appointment. Marvin, in some sense, is hawkish. But on the other hand, Marvin is also somebody who brings a lot to the table, and he listens. And Marvin actually is not somebody who's a fanatic, thinking that there's only one way to view monetary policy, that it's been way too easy because of all the quantitative easing. I don't see Marvin as somebody who will radically change what's going on. He'll just add to the discussion in a very positive way.
Rick, I'm so glad you bring this up, because you go to the heart of the matter where one voice can't change the Fed. But if the President of the United States selects Marvin Goodfriend here, and another more conservative governor there, and a vice chairman here, can't that additive block affect a chairman, or is this not like the Supreme Court?
It's not like the Supreme Court. This is an organization that operates very much on consensus, and furthermore has a long history and a history of decision-making. So the staff is not changing. The staff has a particular view which has been fed into the kind of policy decisions we've seen recently, and that kind of view is still going to be there. First of all, it's very rare that a chairman is blocked by other members of the FOMC. The chairman has a lot of clout if they have respect from the other people on the FOMC, and I'm sure that Jay will. And in particular, that a choice of somebody like Marvin, who is somebody who is a team player, but will add a lot to the discussion, is actually exactly what the Fed needs and should not radically change what it does. And I know Marvin very well. I've known him, actually, God knows, for close to 40 years. And this is somebody who's very sensible, who it will take into account the views of other people in a very sensible way. And Marvin is, even though may appear hawkish in some sense, because he does focus so much on inflation, he recognizes that inflation scares could be a problem, but that's not the problem we have right now, that inflation is not getting out of control. In fact, our big problem is inflation is too low.
I want to welcome everyone once again. This is the Fed Decides on Bloomberg Television and Bloomberg Radio. We have with us Neil Stoss of Credit Suisse, Diane Swunk of DS Economics, and Rick Mishkin of the University of, or I should say Columbia University. I got that backwards. Diane, I want to bring you into this conversation on Marvin Goodfriend. How will he influence the thinking in the Federal Reserve? Is he, we talk about him being hawkish, but is that going to be the way he impacts the thinking and the proceedings at the Fed?
No, I think Rick hit the nail on the head, and he knows him personally. I've been talking to a lot of people within the Fed system who are actually very excited about his appointment, think very highly of him. And he knows he's been thinking a lot about the balance sheet. And this is, the Fed is going to be stepping up the shrinkage of the balance sheet as we move into the new year. And this is something that's uncharted territory. And the fact that he's thought about it so much, there's a lot of people within the Fed system that are really welcoming that perspective that he's going to bring to the table. I also want to underscore something else that Rick said, and that is this dichotomy between the easy financial conditions and the lack of inflation. Jay Powell, one of the things that Governor Powell is really good at is the plumbings of the financial system. And he'll bring, I think, a lot of more focus into financial stability, which is going to be where that tension is next year of inflation versus financial stability, and how much do they keep conditions easy because inflation is low versus how much do they have to raise rates because financial conditions are still getting easier and we could be stoking asset price bubbles out there. And so on all those fronts, I think not only will Goodfriend be an extremely important addition, and agreeing with Rick, he knows him. I just know other people in the Fed who are very excited about him joining the Fed and bringing his perspective. It's a different perspective, a well-thought-out perspective, and diversity among perspectives on the Fed and that debate is the richness of what we need to make informed decisions going forward.
Always welcome. And as you were speaking, I pulled up a chart here that shows how financial conditions have continued to ease, certainly after the election, but certainly after the Federal Reserve began its normalization process. You could see 1, 2, 3, 4, and of course today 5 rate increases since the end of 2015. And still, conditions continue to ease. For anyone on radio, just look for the chart to go up, up, up when it comes to financial conditions. Neil Stoss, Diane mentioned the balance sheet reduction. Yeah. Do conditions start to tighten when we see the balance sheet reduction pick up pace?
That, I think, is precisely how you square this circle, if you need to. If you're worried about the markets being frothy or overheated or whatever, and you don't want to change interest rates per se, then you perhaps could accelerate the movement in the balance sheet, or acknowledge the fact that as we move into next year, the balance sheet's going to be shrinking at a faster pace, and the Europeans will be stopping their purchases in due course, which means global liquidity will be receding.
Did you study Samuelson 48? Was that your textbook, Neil, in school? Okay, Neil Saw studied Samuelson 48. I got a gorgeous copy of it at home. Michigan memorized it when he was 17 years old. Diane Swank was too young for Samuelson 48. Rick Mishkin, your textbook is original. The back third is on policy. Of all the economists we speak to, you're maybe more qualified to talk about the Tax Cut Act literally being birthed by the president in the next 14 minutes or 20 minutes. Rick Mishkin, on the tax cut bill, what will be the effect on Chairman Powell and the American economy?
Well, we still don't know the full features of the bill, but I think that people are overestimating how big an impact this bill is going to have. Yes, it does. The lowering of corporate taxes will be a positive for investment, but we don't know how much. That corporations have a tremendous amount of cash. They have been unwilling to spend it. In fact, the thing that's really been, in some sense, helping drive the U.S. economy is that we're seeing the rest of the world come back. So it's not clear that this is going to have a huge impact on the economy. To the extent that it is expansionary, however, it's not coming at the right time because we're already at full employment. Our problem is not that the economy isn't strong. And expansionary policy from the fiscal side probably is going to be something that will actually make the Fed have to move a little bit faster. But I don't think the impact is going to be all that huge.
What about you, Diane? How do you see the impact of the tax cut here on monetary policy, on the economy, more importantly?
Well, I agree, actually, with Rick. I mean, the way that this is structured, as what we know of, is not going to have a major impact on the economy. What I worry about longer term is the effect on deficits and the debt, and to be, sort of spending our dry powder now before we have a downturn as well. And I think, Rich made this point about, we're doing this when we're close to full employment. What are we going to do when the economy actually falters? And I think not having that dry powder, it is very concerning. And the structure of this tax cut, we do need corporate tax reform. I just wish it had been revenue neutral, and I wish there had been a little more time and thought put into it, because I think it was really rushed, and that's what you're seeing come out right now.
Diane Swank, thank you so much for your attendance today. Diane Swank with DS Economics in Chicago. We continue with former Governor Mishkin of Columbia University, and of course, Neil Sauce with us as well. Neil, this is an historic moment, and there's always a shift when a chairman comes in. There's a process. Larry Meyer, with his wonderful book, A Term at the Fed, talked about the uniqueness of the Greenspan dynamic as well. How do the PhDs at the Fed, staff, which you were a huge part of in your youth, how do they rally around a new chairman?
Quite readily. It's an organization.
Is this done at Starbucks?
No, the organization chart of the Fed is extremely stable. I've often analogized it, frankly, to the organization chart of the Catholic Church. There's a pope, there's a college of cardinals, and then, of course, there are the parish priests and so forth. And that kind of organization, it's not a trivial point, that organization chart's been in place for almost 2,000 years. So it's a very stable culture, and I think it's going to be quite easy for the staff to continue the respect that I think we all recognize they have already for Jerome Powell.
So, Rick Mishkin, does it matter that the Fed chair, the new Fed chairman, doesn't have a PhD, that he has a law degree, but he's not a PhD?
I think it does matter, but I think that it's different when the person who is becoming the Fed chair has been at the Fed for quite a while and has gained the respect of people as being a very sensible person who actually listens and actually has gotten an understanding of economics by learning from the people that are at the Fed. So if this was a person who did not have a PhD, really was not somebody who we thought of as an economist, and he had not been inside the system for a bunch of years, and also viewed as successful in the system, then I would be much more concerned. I will say, however, that I think that it is important that appointments to the Fed at the current juncture with a chairman that's not a PhD in economics, that we bring some good expertise in terms of economics to the Fed. And there are two really important positions here. One is the vice chair of the FOMC, which is in fact the president of the Federal Reserve Bank of New York, and that's going to be somebody new, and I hope it's somebody who's a very good economist. And then second is the vice chair of the board, and we don't know.
Rick, thank you so much. Rick Mishkin of Columbia University. Scarlett?
And our thanks to Neil Stoss of Credit Suisse as well. Let's listen in to Janet Yellen's news conference.
By 1/4 percentage point, bringing it to 1.25 to 1.5%. Our decision reflects our assessment that a gradual removal of monetary policy accommodation will sustain a strong labor market while fostering a return of inflation to 2%, consistent with the maximum employment and price stability objectives assigned to us by law. Before saying more about our decision, I'll review recent economic developments and the outlook. Following a slowdown in the first quarter, economic growth stepped up to a solid 3.25% pace in the second and third quarters of the year. Household spending has been expanding at a moderate rate, business investment has picked up, and favorable economic conditions abroad have supported exports. Overall, we continue to expect that the economy will expand at a moderate pace. While changes in tax policy will likely provide some lift to economic activity in coming years, the magnitude and timing of the macroeconomic effects of any tax package remain uncertain. Smoothing through hurricane-related fluctuations, job gains averaged 170,000 per month over the 3 months ending in November, well above estimates of the pace necessary to absorb new entrants to the labor force. The unemployment rate has declined further in recent months, and at 4.1% in November, was modestly below the median of FOMC participants' estimates of its longer-run normal level. Broader measures of labor market utilization have also continued to strengthen. Participation in the labor force has changed little on net over the past 4 years. Given the underlying downward trend in participation, stemming largely from the aging of the U.S. population, a relatively steady participation rate is a further sign of improved conditions in the labor market. We expect that the job market will remain strong in the years ahead. You may have noticed that we altered the statement language about the labor market outlook. This change highlights that the committee expects the labor market to remain strong, with sustained job creation, ample opportunities for workers, and rising wages. We anticipate some further strengthening in labor market conditions in the months ahead. However, we expect the pace of job gains to moderate over time as we gradually reduce the degree of monetary policy accommodation. Allowing the labor market to overheat would raise the risk that monetary policy would need to tighten abruptly at a later stage, jeopardizing the economic expansion. Even with a firming of economic growth and a stronger labor market, inflation has continued to run below the FOMC's 2% longer-run objective. The 12-month change in the price index for personal consumption expenditures was 1.6% in October, up a bit from the summer, but still below rates seen earlier in the year. Core inflation, which excludes the volatile food and energy categories, has followed a similar pattern and was 1.4% in October. We continue to believe that this year's surprising softness in inflation primarily reflects transitory developments that are largely unrelated to broader economic conditions. As a result, we still expect inflation will move up and stabilize around 2% over the next couple of years. Nonetheless, as I've noted previously, our understanding of the forces driving inflation is imperfect. As emphasized in our statement, we will carefully monitor actual and expected inflation developments relative to our symmetric inflation goal. And as I've noted before, we're prepared to adjust monetary policy as needed to achieve our inflation and employment objectives over the medium term. Let me turn to the economic projections that committee participants submitted for this meeting. As always, participants conditioned their projections on their own individual views of appropriate monetary policy, which in turn depend on each participant's assessment of the many factors that shape the outlook. The median projection for growth of inflation-adjusted gross domestic product, or real GDP, is 2.5% this year and next, and moderates to 2% by 2020, a bit above its estimated longer-run rate. The median projection for the unemployment rate stands at 4.1% in the fourth quarter of this year and runs close to 4% over the next 3 years, modestly below the median estimate of its longer-run normal rate. Finally, the median inflation projection is 1.7% this year, 1.9% next year, and 2% in 2019 and 2020. Compared with the projections made in September, real GDP growth is a little stronger, the unemployment rate is a bit lower, and inflation is essentially unchanged. Participants generally identified changes in tax policy as a factor supporting this modestly stronger outlook, although many noted that much uncertainty remains about the macroeconomic effects of the specific measures that ultimately may be implemented. Returning to monetary policy, for the past 2 years, the FOMC has been gradually increasing its target range for the federal funds rate as the economy has continued to make progress toward our goals of maximum employment and price stability. Our decision today continues this process. We still expect that the ongoing strength of the economy will warrant gradual increases in the federal funds rate. That expectation is based on our view that this rate remains somewhat below its neutral level. That is, the level that is neither expansionary nor contractionary and keeps the economy operating on an even keel. Because the neutral rate currently appears to be quite low by historical standards, the federal funds rate would not have to rise much further to get to a neutral policy stance. But because we also expect the neutral level of the federal funds rate to rise somewhat over time, additional gradual rate hikes are likely to be appropriate over the next few years to sustain a strong labor market and stabilize inflation around our 2% longer-run objective. Even so, the committee continues to anticipate that the longer-run neutral level of the federal funds rate is likely to remain below levels that prevailed in previous decades. This view is consistent with participants' projections of appropriate monetary policy. The median projection for the federal funds rate is 2.1% at the end of next year, 2.7% at the end of 2019, and 3.1% in 2020. Compared with the projections made in September, the median path for the federal funds rate is unchanged through 2019 and a touch higher in 2020. I should note that the economic outlook is highly uncertain, and participants will adjust their assessments of the appropriate path for the federal funds rate as their economic outlooks and views of the risks to the outlook change. Policy is not on a preset course. Additionally, the committee's balance sheet normalization program, initiated in October, is proceeding. As we've noted previously, changing the target range for the federal funds rate is our primary means of adjusting the stance of monetary policy, and we do not foresee a need to alter our balance sheet normalization program. Hence, our statement no longer mentions this program. Of course, we would be prepared to resume reinvestments if a material deterioration in the economic outlook were to warrant a sizable reduction in the federal funds rate. Finally, I'd like to note that although I have one more FOMC meeting to attend in the new year, this will be my last scheduled news conference. Over the next month and a half, I will do my utmost to ensure a smooth transition to my designated successor, Jay Powell. I am confident that he is as deeply committed as I have been to the Federal Reserve's vital public mission. Thank you for being such an attentive audience these past 4 years, and as always, I'll be happy to take your questions.
Marty, and then to Harriet.
Marty Krutzinger, Associated Press. Madam Chair, could you give us any insight into the discussion and how it dealt with the major tax changes that Congress is considering now? There have been thoughts that with these changes happening at a time when the economy is already with unemployment so low that the Fed may be forced to increase its pace on rate hikes. Did any of that discussion come up in your meeting?
So, yes, we did discuss tax policy, and let me say that most of my colleagues factored in the prospect of fiscal stimulus along the lines of what's being contemplated by Congress into their projections. Now, I should emphasize that some have been incorporating those expectations into their projections throughout the year. So changes to the projections that you see since September should not be viewed as an estimate of the impact of the tax package. And in particular, broader expectations of changes to fiscal policy have been reflected in financial market conditions, I think, over the past year. For example, we have seen a significant increase in the stock market, and at least some portion of that I would judge likely partly reflected expected tax changes. And that effect, along with other financial market effects, which affects, for example, projected consumer spending and would have affected wealth. That's been part of participants' forecasts now for some time. I think my colleagues and I are in line with the general expectation among most economists that the type of tax changes that are likely to be enacted would tend to provide some modest lift to GDP growth in the coming years. And you see that in part, that's one of the reasons, I think, for the uptick you see in estimated growth and decline in the unemployment rate. The views of participants, I believe, have been informed by a wide range of analysis, including that of the Joint Committee on Taxation and other outside evaluators. And my sense is that their estimates are essentially in the same ballpark, although they recognize, as I emphasize, that there is considerable uncertainty about the impacts, and that will have to be monitored over time. More specifically, they tend to see the package as boosting both consumer spending and capital spending to some extent. Now, to the extent that the changes do have positive impact on the growth of potential GDP and longer-run growth, let me just say that this is something that, should it occur, would be very welcome to participants, as long as it's consistent with the attainment of our employment and inflation objectives. I guess I would also urge you to remember that when you look at the projections, that there are many factors that affect those projections, and changes in tax policy, that's only one of a number of factors, including incoming data that has, to some extent, altered the outlook for growth and inflation. All of that factors into the projections you see. But I think bottom line, when you look at assessments of the funds rate path, participants continue to see gradual increases in the target rate for the federal funds rate as being appropriate to sustain a strong labor market and bring inflation back to 2%. And look, importantly, there is a lot of uncertainty about what the likely effects will be, and my colleagues and I will be committed and, as always, to evaluating incoming data and altering the outlook as appropriate.
Hi, Tori with Dow Jones Newswires. You and others at the Fed have said that soft inflation should be transitory. Are you confident that that will still be the case, particularly regarding wage gains? They've been pretty moderate in recent months, yet the economy is growing and confidence is high. Is there something going on in the economy that's making it difficult for businesses to raise wages?
So it is true that incoming wage data suggests only modest upward pressure on wages. That leads me, that's one factor, along with the fact that inflation remains low, with feeling that even though we have a 4.1% unemployment rate, that the labor market is not overheated at this point. Remember, the modest pace of wage gains also probably reflects slow productivity growth. But when you ask me about the outlook for inflation, I've talked in detail about this in the past and recognized that there is uncertainty about what's holding inflation down. But my colleagues and I continue to believe that the factors that are responsible this year for holding inflation down are likely to prove transitory. That said, we all agree that our inflation objective is extremely important. We recognize that there's been a prolonged shortfall. This is a symmetric 2% inflation objective, and we continue to indicate that we'll be monitoring inflation developments closely. And so this is on the horizon and recognized to be one of the risks facing policy.
Thank you, Nick Temeros of the Wall Street Journal. Chair Yellen, I wanted to follow up on the question about tax changes. When you addressed it earlier today and when you spoke to Congress last month, you often described that you would welcome higher growth in the context of the employment and inflation mandate. And I guess I wonder how you judge the major provisions of the House and Senate tax plans, the corporate rate cut, immediate expensing of big-ticket purchases, new rates for pass-throughs, temporary rate cuts for individuals. Do you see those on balance boosting the productive capacity of the U.S. economy as opposed to simply increasing aggregate demand? And related to that, how would you view the benefit of such tax changes now when the economy is nearing full employment versus at earlier periods when there was greater resource slack?
So I think my colleagues and I mainly see the likely tax package as boosting aggregate demand, but also having some potential to boost aggregate supply. So changes on the corporate tax side, the reduction in the corporate tax rate, expensing, will lower the cost of capital. And while there are a range of estimates and uncertainty about how much stimulus that will provide to investment, in general, I would see some stimulus to investment. In terms of aggregate supply effects, a stronger pace of investment could boost capital formation and thereby raise productivity growth and potential GDP or output to some extent. Exactly how large those effects might be remain uncertain, but that is a channel. And I suppose it's also possible I'm uncertain how significant this would be, that lower marginal effective tax rates for those groups that will see them could boost labor supply. And again, there are a range of estimates in the literatures. I indicated, I think participants who've reviewed a number of pieces of analysis, including the Joint Committee on Taxation Estimates and the many outside analysts who have weighed in on this and been influenced by that kind of analysis. But there is a good deal of uncertainty about what the impacts would be, and to the extent that there are larger impacts than those analyses assume on aggregate supply or potential GDP in the context of an economy that has had disturbingly low productivity growth, that would be welcome and could support faster GDP growth, at least for some period, without without creating a need to tighten monetary policy to offset that. So there are potentially both demand and supply effects here. So importantly, you really don't, at the end of the day, see very much change in the federal funds rate path. Participants do recognize that the unemployment rate is lower than their estimates of its long-run sustainable rate. So I think we are in the vicinity of full employment.
Heather Long from The Washington Post. You've mentioned that the committee thinks there will be wage increases next year. I'm wondering if you could clarify if that is coming in part or mostly from the changes to the tax plan. Is that what the expectation is, would drive the wage increases? And I was also wondering, I've heard from so many female economists in academia and at the Fed about what an inspiration you've been to them and how melancholy they will be to see you go. I was wondering if you just had any final words to young females and minorities who may be looking to enter economics or banking profession and rise to your level.
I'm sorry, so remind me the first part of your
wages. Is the tax policy driving wage increase expectation?
Well, I think generally in a strong labor market where many firms are having difficulty finding qualified workers, we would expect just through normal demand and supply channels to see some upward pressure on wage growth over time. And as the labor market is tightened, we've seen some very gradual drift upward in wage gains. It remains at a low level, but would expect in the context of an ongoing strong labor market to see some upward pressure. And I believe that's the main thing that my colleagues are factoring in. On your question on advice to women and minorities, in the Federal Reserve, my colleagues and I are very focused on wanting to see and do what we can to foster greater participation of women and minorities in economics. We would love to, if we could, increase our hiring ourselves of women and minorities. And we see that both women and minorities are studying economics in disproportionately and disturbingly low numbers. Although the women in STEM fields generally are about even with men, represent about 50% in economics. Women majors constitute something like 30% of undergraduate majors, and there is disproportionate low enrollment of minorities. I will just say from my own experience, I think economics is a terrific field. I've thoroughly enjoyed my career in economics and think there are many different paths that people can follow that lead to satisfying careers, and that there are very interesting and important questions that economics addresses, and it is a great field, and would like to encourage greater involvement and think that people will find that